So 2019 has passed, so we have some new numbers here for the returns of past year. But most importantly, we're going to take a look at the long-term trends because so many people overlook that. 2019 had a great return for stocks, 27%, as well as gold, 18%. So the permanent portfolio did very well because that's a mixture of 75% stocks and 25% physical gold. I believe that's the best combination. If you look at the long-term returns, it's not actually a belief. It's backed by numbers. The average return is actually 8.7% of such a portfolio, even though gold on average has only 5% since 1928. Stocks have 9%, but if you take a mixture of 25% gold and 75% stocks, you still have 8.7%. That's quite remarkable. And why is that? Well, it's because you, balance every year. And so that means the thing that went up, you end up selling, and the thing that went down, you end up buying. And so that's how you have, much more stable returns that are also relatively high. And then, for example, just stocks, that would not be a great idea because here you can see the long-term return of stocks, but after inflation, actually that's only 3.3% after inflation. I'm sorry, my boy is here too. But as you see with gold, it's negative. And the inflation I take is the amount of US dollars printed minus 2% per year because that's the economic growth. And they print about 8% per year on average. And that leads to about 6% inflation, or let's say 5%, 5.5%. And that's indeed also when you verify with products and services and utilities. If you look at the rise in prices, it's about 5% per year. I will link the video below where I do that test for many products and services and commodities and assets. And actually very interesting, it also pans out with gold because gold does not have a return. Gold is gold. You buy a kilogram of gold or an ounce of gold 100 years ago. What do you have today? Exactly the same. 1 kilogram of gold or 1 ounce of gold. Did it lose purchasing power? Yes, a little bit. About 1% per year. Why? Because the gold has gone down in importance in the world. 100 years ago, we were actually still on a gold standard. People actually used gold coins still as payments. Today, it's only in India where that still happens, but not in the West. So the value of gold has gone down, but slowly, only with 1% per year in purchasing power. In contrast to cash, that's of course a disaster. I don't have it here, but what I do have is the interest rates, which is basically cash. You get about, on average, the past 100 years, 4%, but that's 1% less. So on cash, you lost actually 2% per year the past 100 years, more than on gold, despite receiving an interest. One moment. So, but if you look at the returns, the after inflation, stocks about 3% per year, gold you lose about 1% per year. But with PP, you make also about 3% per year. It's even closer than the gap here. Yeah, it's about the same. You win a little bit more with stocks, but the 3% per year is on average over the past 100 years. As you can see, it really is very volatile over the decades. So 3% per year, that means sometimes you have like 10% per year, for example, in the 50s and the 60s, over a 10-year period. You have 10% per year after inflation, but sometimes you lose like 2% per year for 10 years, for example, in the 70s after inflation. Or recently in 2000 and 2000, just after the crisis of 2008, you had lost about 5% per year after inflation for the past 10 years. So sometimes 100% stocks, as quite a few people recommend, even Edward Thorpe, an absolute genius in the world of investing, recommends 100% stock index. Warren Buffett also recommends it, even though he doesn't follow it with his own cash position, to the chagrin of his investors. But it's really not a great strategy to be 100% in stocks, because losing 5% per year for 10 years in a row, that means you lost 50% of your purchasing power of your capital. That's what can happen with being invested only in stocks. So people like Warren Buffett and Edward Thorpe ignore gold, and there is strong evidence that actually gold is a very, very, very valuable asset in a portfolio, because right when if you aim to keep purchasing power of your money, right when stocks do poorly, for example in the 70s, and in the new decade from 2000 to 2010, right when stocks do poorly, gold does tremendous. Gold does very, very well. And it's actually in the 70s it was an outlier, I think, because the gold price was fixed for 50 years here, and terrible performance in the 40s, 50s, 60s. You lost about 8% per year in purchasing power with gold. That's tremendous. That's being totally wiped out after 20, 30 years, losing every year 5, 6, 7% on average. That means you lost about 80% or so after 30 years in purchasing power. But the price was locked, and actually, yeah, what was happening here was that central banks all over the world were really selling a lot of gold, and really losing their gold stash that they had built up before, and due to that, we're able to keep the price of gold quite low at about $32 for 50 years or so, for 40 years, and so really we're suppressing the gold price because they were dumping a lot of their golds from their vaults on the market. But that story was finished early 70s. They closed the gold window. They closed the sales of their gold stash, but also due to that, they had to let the gold price. They couldn't suppress it anymore, and it became freely floated on the market, and it jumped up a lot over the 10 years from 1970 to 1980. Leading to, it was about $32, and it went to about $800 or so, and that means you had a return after inflation of about 20% per year for 10 years in a row. And if you took a mixture, then that's the green line of the PP, you end up with, yeah, even the PP here, early 70s, has like 0% return after inflation. But that means you still have your purchasing power. You still have 5% per year, but after inflation is 0% per year. But in the 70s, thanks to having 25% gold, you end up having also 5 to even 10% per year after inflation. And then in the 80s, 90s, when gold is a total nightmare, losing it yet again from about $800 to about $200, a lot of value. And that's not counted for inflation. But yeah, stocks go up a lot again, and so you end up with the green line about 10 and then 5%. And indeed, in 2000, you have again 0% with the PP, but after inflation. But and stocks have about 5% here. But yeah, you can see the green line almost never dips below 0%, only once here the past 100 years. Also in 2008, had a small loss, about 2% per year or so, 3% per year. You can see that here then, here 2% per year for the past 10 years after inflation. Okay, that's bad, but it's much better than losing 5% per year. And that's thanks to the gold that you had in the portfolio. But what I would like to talk about also here is the inflation numbers, because people really don't have a clear view on how much money the Federal Reserve is printing, because this is about US dollar returns. And look at what they've been printing. Actually, only 1% in 2019 they increased the money supply. The years before, 4 years, they've reduced the money supply. And so the average, of course, during the economic crisis of 2008, starting 2008 here, they printed a lot. Huh? And due to that, before, the average amount of money printed was about 4% per year. But once everything was said and done here, until 2014, they were printing. They increased the amount of money in circulation per year for the last 10 years from 4% to about 18% per year for the last 10 years. That many Goldbergs were saying will create a lot of inflation, but typically after such an economic crisis, they also reduce the amount of money in circulation. And how does that work? They just basically all the assets that they've been buying. Here they print a lot of new money and they buy all kind of crappy assets, such as uh, government bonds. Of course, they always buy government bonds, but in addition, they will be buying bank bonds and mortgages that have gone broke, and they will pay like the value in the market is like maybe 10 cents on the dollar, and they will buy it for full value to bail out banks. So they buy a lot of crap, and they increase the amount of money in circulation due to it. But later they also sell some of that crap again, and they don't buy new crap. And because they are able to sell some crap, or the government bonds, they don't roll them all over, and so they end up getting cash, and not buying new stuff with the cash. Then they also destroy that cash. It's actually not physical cash. It's just an entry in their computer. So that's how they issue money. They just increase the numbers in their computer, and then they also reduce the numbers. And you can see that at the balance sheet. So today, the last 10 years, of course, this year just dropped off. The last 10 years starts actually now in 2009. They also only printed about 6% per year, which is indeed about the inflation, the actual real inflation, the loss of purchasing power. So, and you see this pattern always in the past. Also, there was a serious economic crisis also in the 30s. Of course, there was still a gold standard then. But once the crisis hit in 1930, they started printing a lot here for that time, and really increased the amount of money in circulation. They also did it in the 40s when there was a world war. But after that, in the 50s, when the times were starting to be good again, they reduced the amount of money in circulation. So that's how these guys operate. But in the end, they do print over the decades about 8% per year, and that leads to about 6%, 5% inflation. The question, of course, is what can we expect for the future? And I think this is very clear, and without a doubt, you can see the trends. Up, returns for stocks went up here, then down, up, down, up, and where will it go next? Most likely, it will continue to go up. And so today we have an average return after inflation of about 3% for stocks, but I will likely go up to about 10% per year, as we've seen in previous. And how long does that take? It's going to take another decade to get here. Like typically, when you're at about 3% returns here, the beginning. How long does that take? Well, it takes another 5 years to be at 10%, and then it takes another 10 years that you continue to be at 10% returns. Same for here. Another 5 years to be at 10% after inflation, and then another decade of great returns for stocks of 10% per year on average after inflation. That means it's actually 15% on average before inflation. So that's to be expected, most likely for stocks. Inversely, gold is only at a loss of 2% per year. It will likely get a lot worse to at least 5% and likely 10% loss of purchasing power per year. And that will be built up over the next 5 years, and then it will stay like that for 10 years after. That's why I'm really bearish on gold, especially today. You can't see it on the chart. I don't know. I know that didn't go up. But especially today, because we just had a bull market, and we just had a great year in gold also. Typically, a bull market gives amazing returns. After that, you have a strong correction, but you will also get some rebound. And I think that's what we've been seeing recently, past few years. a rebound. It went from $1,800 to $1,000 or so, $1,100 here, and then it went up to now $1,500. But that's very likely a rebound that will, and the price will likely go a lot lower for gold to roughly estimated like maybe $500 or so in 10 years from here. So that's really that's how you destroy your capital. However, many people have a cash position because I do think gold still has a great function because first of all, you're never sure about this. We talk probabilities here. There are always scenarios possible where actually these patterns can be broken and gold can indeed go back into a bull market and stocks in a bear market and way out of line with what you would expect. But that's very unlikely. But there is a small chance. So if you want to protect against all scenarios, you do need to put it in. But actually, the financial loss is not that high. Even if you have 25% stocks and let's say gold is in a bear market, well, let's look at the returns here. Of the PP, you can see the green line. Gold is in a bear market from 80 and 90s. But what does happen with the PP? The PP stays at about 10, 5%, 10%, 5% returns after inflation. Despite having 25% in gold, it's really like going down the drain completely. The PP is really able to keep its high returns. And it's only when like yeah, so I think that's really noteworthy, and especially like the thing is many people have a cash position. Most investors maybe 10-20% waiting for opportunities, but some even 50, 60, 70, and even 100% cash traders I notice. And so they take positions but with a small amount of their portfolio with leverage on it. It means they always have a very big cash position. And for me, it makes no economical sense to have a cash position uh, at 0% interest. That's really a terrible investment. Every year, it's a terrible investment because every year you have 5% inflation. Like the prices of products and services at a steady rate always go up with 5% per year. Okay, sometimes it's commodities go up more and then less, but if commodities go up less, then it's usually real estate that goes up more. And so, yeah. Uh, you really can count on that 5% inflation. So to have cash for 1 year standing somewhere without earning interest is really a big loss of 5%. And you can easily avoid that by just putting in a stock index fund and a piece also in gold. And that way you will have not 0%, but about 8% on average per year. That's a huge difference. And that means instead of making a loss of 5%, you make a profit of 3%. So I think this is the real great value you see here. Also, another very important trend is interest rates. You can see they were very low here after the Great Depression of the 30s. Also about 0% interest rates. Let's go back here in the 30s. You see they were normal, 5%, but then they dropped to 0% also, and for very long, like a decade, 1%. The next decade is like 2%. The decade after is back at 4-5%. This is exactly what we've seen again. A normal rates before the economic crisis, 5%, and then it drops to 0% for a decade, and now it's at 1%, 2%. It will likely stay for another decade at about 2%, and then after that, it will go back to 5%. So you can see, like, and that means for cash, um, all this period you have like a losses of 5%, 4% after inflation. And cash here actually turns great profits. You can also with cash make great profits of about 5% after inflation. The interest rates went up here to about 15%, 10 to 15% in the early 80s. So that was a great investment then, but now it's also a terrible investment again, losing 5% per year, and likely we're at the bottom and will be turning up again. But it will take another 2 decades before cash again makes money after counting for real inflation. So up until then, you really need a better solution for your cash, and the PP can really help there. That was it, guys. Thanks for watching and have a great day.